Everybody. Welcome to the November real estate trends. So how you doing, Joe?
Nick, I'm doing fantastic, man. Thanks so much for having me today. It's great to
Yeah,
see you.
absolutely. I was going to introduce you, but I think at this point, everybody has seen your face every single month on this, so they must know who you are at this point in time.
Well,
Um,
I'm gonna need like a solid 30, 45-minute introduction, so that everybody knows who I am. So go ahead and get started on that, and then I'll do the presentation. No, I'm just kidding.
Awesome. Yeah. Well, everybody, appreciate you being here. There's a comment or a chat box on the right-hand side. So if you have any questions, please feel free to send them over and we'll cover them as we go along here. We've got about 40 slides to go through here, chock full of great information. Um, you know, this is like the real deal because there must be some really large event going on tonight. That's why we have a little bit low attendance, but we still have a ton of people here. There must be something else going on.
Yeah, must be
So
something on TV.
yeah. So really appreciate you all being here, of course, even with the election night and everything. I can tell you all really are intrigued by our real estate trends. So appreciate the time and consideration that you're putting in here. So as you all know, this is the Denver real estate trends. This is going to be the latest round of updates for you. I'm going to skip through here some of these slides. I'm going to kick it off here with our, I always say this, our love letter from our attorney. Obviously, as you guys know, this is a real estate trends webinar, so we're not going to be promoting any sort of investment opportunity. There's no offering of that whatsoever. There will be some things mentioned, as you'll see probably on an upcoming slide here. As you know, any investment in any fund or anything in general involves a certain degree of risk, and you must be aware of that. You may see some things, well, you won't see on this presentation, forward-looking statements. We're not going to be mentioning things like project, should, expect, plan. We're not going to be talking a lot really at all about investments here. Anything that you do see, again, like on an upcoming slide we'll have here, it's all company sourced information. So if you have any questions, or whether you're an investor with us now and you want to learn more about what we have, or you're a new investor interested in going down the passive route, you can reach out to me after the webinar or tomorrow. Here's the investment committee at Ironton Capital. I know you all know who Lon Welsh is. We also are not joined here, but we also have Brent Geyer, who's our CEO at Ironton Capital, Richard Landry, he's our Chief Investment Officer. There is their bio. Again, if you want to dig into this a little bit further and get to know us more, you can reach out. Regarding passive investing, we do have a couple funds for investors that are available. A lot of the trends that you'll see on today's webinar, a lot of our investors are paying attention to those trends and they're looking forward and trying to adjust their strategy as such. And they're going down that road of passive investing. We've got multiple growth funds at Ironton Capital where we're projecting about 17 to 20% internal rate of return per year. We diversify that fund across 8 to 10 investments within one fund. If you're looking for cash flow and income today, we've got a short-term and a medium-term income fund that return 8 to 9% a year and 11 to 13% a year, respectively. And then occasionally we have a single asset fund that doesn't necessarily fit the strategy of NDF, but maybe it's a local investment in Denver, such as our little townhome project, 10-unit townhome project in West Colfax, Sloan's Lake. We have projects like that that come up every once in a while. So this is a summary. If you want to learn more about each fund, again, reach out to me. I'll put my email address in the chat box here. With that being said, I wanted to coast through that to get to the meat and potatoes and the important information. So, Joe, I'm going to turn it over to you.
Yeah, well, thank you so much, Nick. It's always a pleasure to be here. For those of you on the call I haven't met, my name is Joe Massey. I'm with Castle & Cook Mortgage and do a lot of presentations with Lon, with Nick, with Your Castle Real Estate, Ironton Capital, JPAR, and I'm just really grateful for the opportunity to present the Denver trends to you guys tonight. So let's jump in and start talking about the Denver market. And I love the title of this slide, Denver's Buyer Market. All right. So we often think about, Denver has been a seller's market since 2012. March of 2012 is when we shifted from being a buyer's market into a seller's market. And it's been a seller's market for Metro Denver for 12 years now. However, we are seeing some shifts in that. And that's part of what we're going to dive into tonight. But you can really see it in 4 neighborhoods here: Highland East, West Colfax, Cherry Creek, and Belcaro. We're all seeing that those have more than 6 months of inventory. Now, real quick, let's talk about the difference between a buyer's market and a seller's market. So seller's market is generally 4 months of inventory or less, meaning that sellers have more power, more negotiating power. You can't get as many concessions. They're going to get their list price or maybe even higher. So seller's market, based on months of inventory, is that 4 months and below. A buyer's market is going to be 6 months of inventory or higher, meaning buyers have more power. They can get some concessions, they can get repairs, they can offer below list price and potentially still get that property under contract. And then right in the middle, in between 4 months and 6 months, is that balanced market, meaning nobody really has the upper hand. Now, in Denver right now, which we're going to talk about on a future slide, it is still a seller's market overall. However, we're seeing some shifts in these 4 neighborhoods, which these are kind of leading indicators because these are pretty popular high-priced neighborhoods like Cherry Creek, Belcaro, Highland East, and West Colfax. These are really good neighborhoods that are very much a leading indicator. And this is as of our third quarter analysis, our July 2024 analysis. We don't have the analysis yet for third quarter, but I expect by the time we have the fourth quarter analysis, we're going to see anywhere from 10 to 15 to maybe 20 neighborhoods that have shifted into a buyer's market. What do you think about that, Nick? Do you think the same, that we're going to see buyer's markets in more neighborhoods?
I think so. I mean, you also have the coinciding event of the election, which has put a lot of people on hold right now. I mean, I can't tell you how many
Yep.
times I've heard people say, "I'm going to wait to make a decision until after the election." Right? It's what a
Yep.
lot of people are waiting for. Additionally, it's just Q4. It's November and December, and we get into January. I mean, those are low months. So you have just traditionally low months coupled with an uncertain market and high interest rate environment, right? So, I mean, again, we've faced a lot of these headwinds over the last couple of years, and it hasn't really changed. But we're really starting to see that happen. It's interesting to see these traditional seller markets flip to buyers markets. I have a friend that just bought a house that was on the market for 180 days
Wow.
in the areas circled here. So it's I saw it as living proof.
Yeah.
Yeah.
Yeah, you're exactly right. So let's talk about some key messages for homes and condos. So average sales price, all right, which is going to be our first box we have up here. And I keep circling stuff with my mouse cursor, although I know you guys can't see my mouse cursor. So I'll try to describe this as best I can. From third quarter of 23 into third quarter of 24, we actually saw that the average home price decreased about 1%. The average price of a condo decreased about 6%. Now, an important point here, that doesn't mean that values necessarily went down. It's just the average sales price, which a portion of that is we're selling more homes at the lower end and less homes at the higher end, right? So a 1% reduction in the average price does not necessarily mean that all homes went down by 1%. We still have seen appreciation in the overall market. Months of inventory. I really like this. If you go from October of 23 to October of 24, you see that months of inventory for homes was at 1.9 months, growing to 2.9 months. So what you see is that 2023 started with inventory very, very low and has started to rise. So what we touched on the last slide, we're still in a seller's market. That 2.9 months of inventory is below 4 months of inventory, but it's not a dysfunctionally tight seller's market.
Mhm.
Under contracts, we're seeing fewer homes under contract in this quarter as we did the last quarter. That's really pretty normal. That's a seasonal adjustment, so no big changes there. But a big one down here on number of solds. You see in the early parts of the late parts of 23 and the early parts of 24, the number of transactions that had closed were down significantly. So if you're on the call and you're a real estate agent, you probably felt some pain through the latter part of 23 and 24. You're just like, man, it feels slow. There's just less transactions occurring. This is what was happening. There was truly just fewer people buying, fewer people selling, just fewer transactions going on. So I think we've gone through that dip and we're now kind of coming out of that. As you see, sales in second quarter of 24 were up 3%, third quarter of 24 up 6%. So we're beginning to dig out from that low transaction count.
Mm.
And then inventory right now is up significantly for homes and condos compared to the same time last year. And this means the competition for buyers has finally eased. So if you go back and you think about 2 years ago, folks were really upset that, man, my buyers are having to pay $10,000 above list price, $50,000 above list price, $100,000 above list price. That is eased. And so it's easier for buyers to get a property under contract right now. So if you're working with buyers, or maybe you are an investor who's looking to buy properties for your own portfolio, I think right now is a really great time that there's some opportunities to get discounts on properties because of this high inventory. Now, some historical context. Over the last 51 years, homes in Denver have appreciated an average of 6.5%, and condos have appreciated an average of 5.6%. All right. Now, in the past couple years, over here on the right-hand side, we saw 10% appreciation, 15, sometimes even 20% appreciation. That's not sustainable. So we expect lower rates of appreciation in the next few years, which is indicated over here on the right-hand side that you see prices flattening and going up slightly, maybe even condos flattening and going down just a little bit, and that dashed blue line. I don't think we're in have any major correction in store that this is going to crash like it did back in 2007, 8, 9, but it's probably going to be flat for a few years. Would you agree with that, Nick?
Yeah, I mean, there was such a different environment, when we think about the crash, which was, '08 and '09. I mean, it was purely just fraudulent lending at the end of the day. And banks got caught with their tail between their legs. Now we're not seeing that. I mean, you can vouch for it, Joe. It's we were just talking about somebody earlier. The underwriting standards are incredibly rigorous and detailed and strict. So the buyers that are getting the homes, they're highly qualified borrowers. The unfortunate reality is that the people in their home buying years, millennials, it's very hard to afford homes in Denver. So, I mean, those two things combined, we're not going to see a crash, but it's just, like you said, it's not sustainable to see that level of appreciation year after year.
Yeah. So I wouldn't be surprised when we're doing one of these webinars in a few years that this line here, this dark line on the right, is pretty flat for the next 2, 3, 5 years. I think home prices will go up, but they're not going to go up at 10, 12, 15, 20%. We're going to see 3%, 4%, 5%. We're going to, again, average out to that 6.5% over the last 51 years. Now, let's talk a little bit more about inventory and buyers and sellers markets. So all the way over here on the left-hand side of the chart, inventory peaked at greater than 35,000 active homes in the middle of 2007. And then you see that begins to come down, and we reach a balanced market from about 2008 until 2012. And then right there in early 2012, as we mentioned earlier, we entered into a seller's market. And we've been in a seller's market for more than a decade now. And that's indicated by this months of inventory being really low. And the reason it looks like a seesaw pattern, not a seesaw, but a sawtooth pattern, is because that's seasonality, right? You sell less homes in the winter, more homes in the summer. That's what this is representing. And then we get all the way over into early 2021, and we are in a dysfunctionally tight seller's market. You could put your dog's house on the market and it would sell in 15 minutes, right? And we experienced that all the way through early 2023, which, as we all remember, in April of 23, that's when interest rates began to go up and crossed over 4% for the first time in the past 3 years. And that's what we see leads to increased inventory over here on the right-hand side of the chart. Again, we're still in a seller's market, but we are approaching a buyer's market. And as we mentioned on the first slide, in some neighborhoods certainly are in a buyer's market. Now, active listings. This is kind of a busy chart, but I think it really tells a good story. So I want you to look at that line in dark green that's dashed. Active inventory is higher over here on the right-hand side at approximately 11,000 homes. Now, this is homes, condos, and townhomes, so it's an aggregate of everything. There's about 11,000 properties on the market, which is higher than we have seen, since, let's go back one slide, since 2011. All right. So there's more opportunity for buyers, but at the exact same moment, there's more frustration for sellers. It's taking longer to sell homes. They're not getting that premium price, $5, $10, $20, $50,000 above listing price like they were a couple of years ago. But for buyers out there, there's certainly opportunities. And then this is the other frustrating thing that you'll see. This light blue line at the very bottom, this is the number of showings per active listing. So showings per active listing are lower than at any point in the last 7 years. So if you've got a listing and you have sellers saying, man, when are we going to have another showing? Where are the people? This is exactly what you're experiencing. There's just fewer showings per listing because there's more listings and there's not as many buyers out there right now.
I wanted to highlight something, just highlighting the buyer opportunity that I think that we're in right now. we're not going to see, in my opinion, and I think the data supports this as well, we're not going to see this massive drop in price. That's not the opportunity. We're not going to see a 30% reduction in home values. And I think sometimes that's what people are waiting for. They're thinking that, um, you know, the interest rates are high. They're thinking that, oh, well, housing's unaffordable, so the prices have to come down, right? But that's not necessarily what drives it. It's a supply and demand problem, right? And like
Right.
08, 09, we had excess supply relative to demand. That's what led to the global financial crisis, among the other things that I had mentioned earlier. I really think the opportunity is the less buyer competition that we have right now. You're not
Right.
competing with buyers. You're not having to level up and go 10, 20, 30K over listing. We might be at 2 to 3% appreciation. I think that is the low point. I mean, I think we probably already passed a point where we did see maybe some negative appreciation. I think that was like early. Was that late? I think that was 2022,
Late
2023.
22, early 23.
Yeah,
Prices
that's
went
where we
down like
really
2%.
saw the dip. Yeah, that's where we really saw the dip. It was Q4 and then I think Q1, right, of 2023.
Yep.
The opportunity is the less buyer competition. You can get some seller concessions. You have a little bit more leverage as a buyer, not so much as a seller. I think that's the buying opportunity. You're not competing with as many people, and the appreciation is low relative to what we've performed historically on an annual basis. I think that's the opportunity, and that's what I'm seeing right now, at least.
I completely agree with you. Completely agree. Now, months of inventory, we touched on this again. This goes all the way back to 1986, right? And so you can see we had some really strong buyers markets in the late 80s. Then we had a decent buyers market in the early 90s. And then one of my favorite points about this, a balanced market doesn't last very long, right? It goes quickly from a buyer's market to a seller's market. Then we've got a seller's market all the way from 92 until 2000 or 2001. Then you get to a buyer's market for a couple of years there. And then we get into this seller's market and a really, really strong dysfunctional seller's market. And looking over here on the far right, you see that we're getting closer to a balanced market. Again, if you've been thinking about selling a property, might want to do that sooner rather than later if we do continue to see inventory increasing, which is just going to make it a little more difficult to sell your property, and the property is likely to sit on the market a little bit longer. Now, in homes, again, what we touched on earlier, we've seen inventory rebound from historic lows, and it is starting to grow, but smaller homes are experiencing faster turnover, right? Which is what would make sense. Interest rates are high. What do initial buyers want to buy? They want to buy a house, but they can't afford $1 million house. So you still have folks fighting over $300,000, $400,000, $500,000 homes. And you see that on this first line here, where homes that are the smallest 10%, average days on market, only 27 days. The second bucket of homes from 1,000 to 1,300 square feet are staying on the market only 24 days. But go down to the last line here, average days on market for the largest 10% of homes, 46 days. And then in green there, the average days on market, 33 days. All right. So again, we are seeing that inventory build. We are seeing a little bit more pressure on sellers at the higher end of the market. And you can see that with this 4.5 months of inventory for the largest 10% of homes. So that correlates to the fourth column here for price changes. Prices are not appreciating as fast on those larger homes. They're appreciating more rapidly in those middle market homes where you just have more buyers that can afford those. But we're still seeing 2.5% average increase in prices from third quarter of last year to third quarter of this year. So overall, back to the same message. If you've got a bigger home, might want to sell it sooner rather than later, or plan to keep it for a period of time. Or if you're a buyer, there's some really good opportunities in those larger homes. And you may still have to slug it out a little bit in those mid-market homes, but you have more power than you did 2 or 3 years ago. And days on market, we touched on that. That rolling average is, just under 40 days on market. Now, inventory nationwide. So this is a Denver Trends presentation, but we do always like to touch on some national averages. And you can see compared to last year, inventory is up 39% in Colorado. and the national average is 35%. There's still some areas that have really, really high increases of inventory. Florida, there's a hurricane that hits Florida like every other weekend. So there's people selling those homes left and right. However, look at Nevada. Nevada has lower inventory. So if you do happen to hold any properties in Nevada, might be a good time to hold them because they're likely still increasing with having really, really low inventory.
Mhm.
And then one of my other favorites, this is appreciation over the last 25 years. And so circled in green is Colorado, which has had the third highest appreciation in the last 25 years. So Nick, if you would have bought a home 25 years ago, that property would have gone up 569%. Whereas the national average, homes have only increased 297% over that same time frame.
Mhm.
So taking that a step further, and we say, hey, inventory is up, people are having trouble affording homes, maybe prices are going to go down. If prices went down 10%, and instead of having gained 569%, you only gained 559%, would that still be a good investment, Nick?
Oh yeah.
Yeah, I completely agree. So I don't think we're going to see any price depreciation or price decreases. But just keep in mind, over the long term, we've had really, really high appreciation. So if we give a little bit back, which I don't think we are, it's probably not the end of the world, even if it does happen.
Well, one other thing I want to mention, if you're a buy and hold investor, you've got a long-term mindset, likely 10 plus years. So the small swings that we have from year to year, the 3%, 2%, 4%, if you're in it for the long game, like a lot of investors are, you're not going to lose. If you're going to plan is to own a home, operate it, if it's investment property, operate it, rent it out, reduce the debt, and just let the appreciation ride over 10 to 15 years. Like you're not going to lose,
Yep.
in my opinion. So the longer you're in it, the more chance you have. So I think this is a really good thing to put into perspective here is, the last couple of years we've had slight dips. We haven't had this high appreciation as usual, but when we look at the grand scheme of things over the last 25 years, Colorado has been one of the highest appreciating markets. And I do think over the next 25 years, maybe it's not 570%, but I still think it's going to be a very high percentage, and you're probably going to make a lot of money.
I agree.
Yeah.
This is a slide that I would show to somebody maybe who's a first-time buyer who's nervous about buying a property. They're like, boy, what if it goes down? How long are you planning to own it? I don't know, 10, 15 years? Cool. The national average over the last 25 years has been 300% appreciation. Let's say you buy that property today and Colorado goes to exactly the national average and it's going to appreciate 300% over the next 25 years. Is that a good deal? I think it is.
Mm-hmm. Yep.
Now, mortgage rates. This is always my favorite topic. Interest rates decreased right around middle of September, and interest rates got as low as 5.9% for some situations, but we have seen that increasing. And now this slide's a little bit outdated. Right there in the center, interest rates are just over 7% as of today. And part of that is the spread above the 10-year Treasury. A lot of the bond houses, mortgage-backed securities, they're worried about prepayment, right? So if somebody takes out a loan at an interest rate of 6, 7, 8%, they're very worried that that loan is going to pay off early. Because of that, that risk spread is higher than normal, which is that big spike that you see on the right-hand side. Over time, that's going to begin to come down, but this is showing we're probably going to have elevated interest rates. When I say elevated, I mean 6, 6.5, 7, maybe 7.5 for, I don't want to say a long term, but certainly for the short term over the next 90, 180 days. Don't expect to see interest rates going back to 2, 3, 4%. Not likely to happen. And then this is another great one to share with buyers. The average over the last 50 years has been 7.7%. And again, this is a little bit outdated, currently right around 7%. So we are still historically below average for interest rates over the last 50 years. Now let's talk about, well, let me pause there. Any questions on some of the data that we dove into before we start talking about some landlord issues? If you have any questions, type them in the chat. We'll keep moving on. But Nick, anything that you want to add to that data?
I don't think so. I think, you're presenting everything very well. When I look at things, I've been looking at things much more from a commercial point of view, right? And so one of the things that we've seen recently is, even though I think what some people might think is, well, the Fed's going to start to lower rates, so that's going to have a very positive impact on mortgage rates. But what's interesting is when we look at things from a commercial standpoint, we've actually seen the Treasury move in the opposite direction of the Fed. So a
Hmm.
lot of rates are based on the 5 or the 10-year Treasury, and that's actually going up, even though the Fed's been lowering their benchmark rate. So it's really interesting to see that from a commercial standpoint. And, I'm highlighting that because that was the most recent slide. And I like this slide too, because it does put things into context. And one thing I will add to this is, though we are at, an average rate that is below the historical average, we're also in a very different generation of people that are buying homes right now as well, right? We have people that
That's
are
right.
we have record-breaking credit card interest or credit card debt. People are paying astronomical interest rates. Student loans are a burden, and then on top of that, you have to come up with $150,000 for a down payment on a home in Denver. So, we're seeing these rates, and I'm curious from your standpoint, Joe. I mean, what do you think is the catalyst to get more buyers off the sideline? Do we need to see rates come down into the fives or low fives? This is, total speculation, but I'm curious on your thoughts. Like, what do you feel is going to be the catalyst for when we start to see things maybe tick back up for sellers who are going to sell their house?
Yeah, there was a survey recently, I believe it was done by either NAR or the Mortgage Broker Association, and 86% of buyers that are on the fence right now, they surveyed, I think, 1,000 people that are currently on the fence. They said that a rate that begins with a 5, so let's call
Mm,
it 5.99, a rate that begins with a 5 would motivate them to get off the fence.
yeah.
So 86% said they need rates in the 5s in order to motivate them to buy a new property. Now,
Mm,
here's the challenge with that. They may not get rates in the 5s for a long period of time. And so existing property owners may continue to experience that appreciation. And the folks that are waiting may miss out on that appreciation if it takes 2 years, 5 years, 10 years for rates to get back into the 5s. A lot of people sitting on the fence may miss the boat for their own wealth creation.
yeah.
But to answer your question directly, rates in the 5s is what the survey says. When that's going to happen, anybody's guess is as good as mine.
Yeah, one thing you mentioned there that I don't believe is actually in this slide deck. You mentioned the wealth accumulation, and you probably know exactly what slide I'm talking about.
I do.
Uh, at the end of the day, the more time you're in the market, the more time you own a home, the more wealth accumulation you're going to create for yourself. And for most people, 80, 90% of their wealth might be in their home, right? In their
Yep.
equity. And so, for a lot of the agents that are on here, we'll have to include that slide in the next deck if it's not already in here. But if you got a lot of buyers that are waiting on the sideline, I'd encourage you to get into the conversation of, what is your net worth accumulation going to look like over the next 5 to 10 years by buying this home today? And I think that's a very compelling story to tell to a buyer because we see that. I think the net worth accumulation for somebody that owns a home relative to a renter is like tenfold. It's much
At
higher,
least.
at
Yeah.
least. And even though we talk about 3% appreciation in Denver, we're talking about a market in which the median and average income or average household house value is what, 600 to $650,000.
Yep.
3% is nothing to snarl at, right? So even though we're seeing lower than historical average or median housing appreciation, you're getting 3 to 5% on very high real estate values. And so that separation between a renter's net worth and a buyer's net worth, or sorry, a homeowner's net worth is going to continue to separate, and that wealth gap will continue to get larger and larger.
I agree.
Yeah.
Completely agree. Now let's touch on an important message here about updates to landlord legislation. So in Colorado, there's been 9 new laws in 2023 that all benefit the tenants and 4 new laws in 2024. Well, what has this done to rental properties? Number one, it's increased supply. All right. We've actually seen a 12% increase in rental supply in 2024. And we're seeing that some properties that used to be Airbnbs are being repositioned as long-term rentals. Now, one of the big reasons for that is we saw a lot of people purchasing Airbnbs in 20, 21, and 22. They rented them out for a period of time. They made great cash flow. But here's the catch with having an Airbnb. The moment you close on that property, you are no longer in the real estate business. You are now suddenly in the hospitality business. And that's a hard business. It's very difficult to run an Airbnb, particularly if you have multiple units spread out all around town. And so we're seeing that some landlords that are operating Airbnbs, they're getting a little bit burned out and they're saying, man, I'm making great cash flow, but this is a lot of work. I'm just going to convert this to a long-term rental because it's going to be a lot easier to just collect rents on a monthly basis.
Mm-hmm.
So demand for rents has been flat. All right. There's just a little bit of growth, but pretty flat. And so when you see supply increasing by 12%, demand is pretty flat. That's going to show flat rental increases. All right. And so what you see is exactly in that local outlook, there's going to be some headwinds for rents going up. You're probably going to see more vacancy. You're probably going to have to give some concessions, right? You remember seeing, you drive by an apartment complex and they say first month's rent free, or, free use of a moving truck to move in. So you're going to start seeing some of those things as supply is outpacing demand on the rental side. And then the other challenge for property investors is there's a lot of increases in property taxes, insurance, and not listed here, HOA dues. So if you own properties, make sure you're managing them really, really tightly. And we're going to talk more about property management on the next couple of slides. So next thing here. So let's see. Derek just posted a question. Am I the only one not hearing anything? Nick, can you hear me?
Yeah, I can hear you. Yeah, I think,
right.
Eric, it might be, I would close out and try to come back in.
Edward said, I can hear you. Okay. So Derek, I think it might be on your side. Maybe close out and re-enter the chat because we've got other folks that say they can't hear us. So let's talk about these 9 new laws that are making everything more difficult. So the highlights you want to be aware of this is 2024. The highlights you want to be aware of: pet ownership. There are certain restrictions now around pet ownership, portable screening reports. So if you have a tenant who gets a background check from one rental company, that background check can be transferred to you. There are certain things that are prohibited in rental agreements. I think this is mostly around medical marijuana and smoking within the unit. I may be wrong on that. I am not a property management expert, but it does remove some landlord protections. And then the eviction process. The eviction process has been slowed down and is more complicated now than it has been in the past. Remote participation in residential evictions. If you can't go to the courthouse for an eviction hearing, you can participate via Zoom. Habitability. This allows tenants to break their lease without penalty if it's found out that the home is not habitable. And then illegal drug laboratory and property certification. This is surrounding meth labs, and landlords must follow some very specific requirements if meth is determined in their property. And then protections, talking about credit reports. All right, considering a subsidized applicant's credit score. So what this means is if you have a property that is up for rent and a tenant comes to you that has a Section 8 voucher, you cannot check their credit in order to make a determination on whether or not you're going to rent to them. So that's a big one that a lot of individual landlords are not aware of. And then, of course, disclosing radon. Now, a lot of folks might look at this and say, wow, this is a lot of stuff that I need to know if I'm a landlord. And I completely agree. And so one thing that I harp on all of these, and, do with this what you want, I'm a big advocate for having a property manager. So a property manager, we're very close with the folks over at CRT Management, Eric Ross and his team. They know these laws inside and out. They provide a level of protection and a level of compliance for landlords to make sure all of these laws are being followed very, very closely. If you're an individual landlord, good on you. You're not paying any management fees, but you do have a lot of new hoops and a lot of new requirements to jump through. Make sure you're understanding this stuff. Make sure that you are understanding how these impact you and your investment properties. And Randy asked, is this for all of Colorado or just Denver? Such a great question. This is all of Colorado. These are state laws. I'm really glad you asked that, Randy. So if you're managing properties in, Grand Junction, these laws apply to you. Or you've got one single unit in Pueblo and you're a landlord and you live here in Denver, these things still apply to that property in Pueblo.
Mm.
Now, some updates for 2024, for-cause eviction. All right. So the circumstances that most frequently give rise to a for-cause eviction are non-payment of rent. All right. Material violation of the lease, repeat violation, substantial violation. But the big thing here is before any eviction action, except for substantial violations, landlords must serve a demand for compliance or possession, allowing tenants a chance to fix the issue. And tenants always have the right to cure non-payment problems. However, for substantial violations, repeat, or unauthorized occupation, landlord must serve a notice of termination before the eviction. So what this does is this complicates the process to evict a tenant. So again, back to what I mentioned earlier, I have a property manager who handles all of this stuff for me, and you don't have to worry about it if you have a property manager. If you're managing your own properties, make sure you are understanding this, because we have seen court cases where an individual landlord will go to court to evict somebody for non-payment and they don't file the paperwork properly. They didn't do that demand for compliance or possession, and that court case will get thrown out and the judge will say, hey, start over. You didn't do your paperwork properly, and now you've got another 30, 60, or 90 days before you can evict that tenant. So if you're managing your own properties, make sure you're understanding your paperwork and your timing requirements on this.
Yep.
Continuing on no fault evictions, the non-renewal notices, or excuse me, that was for cause evictions. Now we're going to talk about no fault evictions. Non-renewal notices, notices to vacate. There are strict usage criteria and pretty big penalties. So something that might happen here is, let's say I own a property and it's been leased out and I decide that I'm going to move back into the property. I can't just tell the tenant, hey, you got to go. I want to move in. You have to give them notice. And if you're planning to occupy that property, you have to give them opportunity for them to move into a new property, or you can let them rent in one of your other properties. So there's lots of rules and requirements around this. It's not as simple as it once was to just say, hey, Mr. Tenant, you've got to leave because I'm going to renovate the property and then sell it, right? You have to give them notice. You have to give them an opportunity to find replacement housing. So lots of rules and requirements around that. And then notices and demands must clearly state the lease violations. And then the notice must be in English, Spanish, or the tenant's primary language. This is something that Eric has shared with me. He has tenants, I think he told me 16 different languages, obviously not in one place, but across his portfolio. And he has had to get all of his paperwork translated into those 16 different languages. So if you're renting a property and you're an individual landlord and you've got someone that lives in there that speaks Arabic, for example, you can't only provide them stuff only in English. You also need to provide it in their primary language in order to be compliant. And if you don't do that and they fail to pay their rent and you go to evict them, you may run into problems in the eviction process. So very important to understand this. And then warranty of habitability. So you really need to make sure that you're keeping your properties habitable and establishing communication with your tenants that if there's a problem, they need to let you know right away. Otherwise, if that property is not habitable, you may run into problems evicting them if they don't pay the rent. And so there's a lot of rules defining when landlords are deemed aware of the conditions, requiring landlords to provide alternative housing for up to 60 days during repairs. All right. Mandating landlords to keep records and requiring new rental agreements to include reporting procedures for unsafe conditions. So providing habitable housing is a big focus of the Colorado legislature. And again, property management companies are all over this, looking at this, being aware of it, inspecting your properties, and making sure you're maintaining this warranty of habitability. So if you're an individual landlord, please make sure you're understanding this. And the big thing, this puts a lot more work and energy onto the landlord. And so what we're seeing because of that, we're seeing some landlords get out of the Denver market and they're saying it's just too hard, or excuse me, out of the Colorado market. And they're saying it's just too hard to have investment properties here. I'm going to put this on the market and sell. Guess what? One of the driving things is on increased inventory, former rental properties. that are now being listed for sale.
Mhm.
Oh, and this is a great comment, Nick. We did do a full webinar with Eric from CRT Management, and he really dives into all of these. He is much more eloquent than I am on these topics. So please email Nick to get a
Yep.
copy of that recording, because it was a really, really good recording. Thank you for that, Nick.
Yep.
Anything to add on that, Nick, before we talk about rental supply?
I don't think so. One thing I do just want to highlight high level, in short, it's becoming very difficult, and I think will become even more difficult to be a landlord in Colorado. I think that's it. I mean, these laws aren't going to reverse. I think we may be just scratching the surface here. If you look at like what Los Angeles did recently, performing renovation, they just voted where performing renovations is not a reason to vacate a tenant. So they're making it harder. California tends to lead the way, right? And so you have more liberal states that tend to follow under their guidance as well. So I think we'll probably continue to see more. It's hard to be a landlord. A lot of investors, they're trying to capitalize on the massive equity appreciation they've had since they bought properties in 2010. In foreclosure. And so we're seeing it more and more. If you're in a situation where it's becoming more of a headache and you're looking to find other ways to optimize your equity, feel free to get a hold of me. We can have that discussion and we can discuss other options for you. But it's getting harder, Joe. And I hear more and more stories every day from investors who have owned for a while in Denver.
Yeah. And we actually did an entire webinar on that topic as well. If you're an active landlord and you're tired of some of these laws, you're tired of some of the work, we did a full webinar on that, which when I turn this back over to Nick, I'll type that link in. So we did a 1-hour webinar to talk about, what if I decided to take some cash out of my rental property and invest it more passively? What would that do? Or what if I decided to sell the property because I'm tired of all of this and it's a lot of work and I wanted to take that equity and invest it passively? What would that do for you? So I'll post the link in the chat as well when I pause here in a few moments. Now let's talk about rental supply. And what you see, this red line is vacancy. And that has begun to increase here in the last year or two. And that goes right along with projects being delivered, which is the yellow bars here that you're seeing. And it indicates that vacancy may increase as we have a lot more units delivered in the first, second, and third quarter of 2025. Now, here's a really important point. There's more than 40,000 units that are under construction in Denver, Boulder, and those are all going to come online in the next year. But all of those, virtually all of them, are luxury A-plus buildings. If you have a B-class rental, C-class rental, not likely that you're going to be impacted by these luxury buildings coming online. However, if you've got luxury condos that you're trying to rent, you may suddenly be feeling some price pressure and vacancy pressure and may have to lower your rents. And what you see there, cash flows for new projects is going to be highly stressed well into 2025. So you're going to see a lot of those luxury high-end apartments offering concessions, first month's free rent, $1 security deposit, free moving truck with a rental, things like that. So don't be surprised if you see some stress in that higher end luxury rental market. And if you have properties like that, I would recommend you get them filled and get them filled with longer term leases sooner rather than later. Would you agree with that, Nick?
Yeah, we're seeing this a lot in multifamily. We're seeing I've even seen nearly 3 to 4 free months of rent being offered on Class A product. So we were not seeing that in 2020, 2021. You could go buy an apartment downtown, do absolutely nothing to it, raise the rents 10%, and have 98% occupancy and look like a rock star. It's not happening now. You have to be skilled at operating an asset, right? And you have to be good at property management. But we're seeing a lot of concessions. So as a renter, you can you're in a good position, I think, because you're not seeing this massive rent growth. But we've got a lot of supply coming on, but in about 2 to 3 years, guess what we haven't had in the last year or two because of all the headwinds in the market? We haven't seen any new permits. We've seen no new starts. And so I think what's going to be happening in another 2 to 3 years is, despite this hyper supply rental concessions, I think in 2026 and 2027, if you're selling an apartment complex or you're trying to lease up an apartment complex, I think that the economics are going to be heavily in your favor, because I think we'll be in a much more diminished supply type of market, considering the lack of permits and new starts we've seen in Denver. And that's really globally, or nationally. But, Denver's also instituted some other really difficult legislation, like anything new must have 15 to 20% affordable housing allocated to the apartment complex. That's made it very difficult to pursue projects and pencil projects out. And so you don't only just have the economic headwinds, but you also have some kind of wonky legislation that's been put in place that'll damper affordability in the market here in Denver as well. So I'm going to put all my eggs or I'm going to put all my money on a statement that in 2 to 3 years, I think we're going to see above 4 to 5% rent growth again in Denver because of those economics.
I completely agree. Over here on the right-hand side where it says 2028 Q1 and you see super low deliveries, we are going to get really good rental appreciation, rental rate appreciation during that year and the coming years. So if you're thinking about buying an investment property, might be a good time to buy it. I understand it's not great cash flow right now, but you're going to pick up some really good cash flow in the coming years. Now, Gail had a question, and I have my opinion on this, Nick, but I'd love your opinion. With individual investors looking to exit the market and wanting to be one of those exiting, is it better to list condos as soon as possible rather than wait it out? C-class condos are sitting on the market longer than the numbers that we presented. And that is true, right? Everything we presented on condo days on market is the overall market. If you've got a C-class property, it probably will sit longer. So what do you think, Nick? Sell that property immediately or wait it out?
I would wait it out. I think right now people are so stretched with their budget that they might only have enough money for the down payment, and then some of the other other costs such as insurance, et cetera, which is also increasing. I think if your condo is in tip-top shape, it's renovated, it's move-in ready, and it looks attractive, I think maybe it could be a good time to sell that condo. But if it's in what is typically a C-class condition, I think you're better off waiting it out, maybe until spring of 2026. Who knows what's going to happen next year? I think it's too soon to think that there's going to be any, turnaround in the next 3 to 4 months, but I would wait it out. Otherwise, if you're trying to list, you're probably going to have to make concessions because the buyer coming in can only afford the down payment, let alone another $10,000 to $15,000 of renovations, on top of it. So affordability is so narrow right now. I would wait it out.
I completely agree. February 15th, we did an analysis on all 365 days and which day of listing your home do you get the highest price as compared to list price. And it is February 15th. So that's really the indication of the beginning of the spring selling market. That's only about 90 days away. So if you can hold on to that property for another 90 days and want to sell it in the spring, I think you're going to be better off than listing it today, particularly for a C-class property. However, if you can wait 90 days plus another year, you might be better off selling it February 15th of 2026. Listing a C-class condo right now, if we were to go back 7 or 8 slides and look at the increased inventory, I would not list that right now unless you are in a desperate place and need access to the capital immediately. So great question, Gail. I'm so glad you asked that. All right. So local supply and demand. Again, we're going to see a lot more new rental units coming on to the market, and additional, but it's not as easy to quantify, that supply from homeowners transitioning from Airbnb, and rental demand is slowing. All right. So we're seeing restart of student loan payments. We're seeing increases in consumer debt, decreases in savings. And one of the things you might see is you used to have Nick living in one apartment, I'm living in another apartment, rents go up, we have to restart our student loans. We can't afford each of our individual apartments anymore. What do? We both move out of our 1-bedroom apartment into a 2-bedroom apartment, and now we're roommates. That is one household that just went away. So that is part of what's leading to some of that decreased demand, is people moving in with one another. Now, difficult to quantify, but we do know that it's happening. All right. And so that has slowed down some of the rental rate growth that we've seen in the past. And in 2024, again, we spoke about this. We're going to see some increased concessions, flat rents, as I just touched on, some increase in vacancy, longer lead times to fill apartments, longer lead times to evict tenants, potential lower tenant quality, giving all of the new laws that we just spoke about, and higher insurance, property taxes, and HOAs are going to compress some of that cash flow. But I think we get to 2026, if we go back a few slides, and when there's very low deliveries, we're going to see a lot of rental increase. So if your property is positively cash flowing and you like the property, keep it. You're going to get some rental rate appreciation in the future. All right, we discussed everything on laws. Last couple of slides. Nick, do you want to touch on any of the testimonials or the last few points here?
Yeah, so here's one from one of our, large investors. Jared, in the last 15 months, he's been in a position where his tenants did not renew their leases. So they went in, they renovated the properties or brought them to a live-in condition. And they've diverted a lot of their capital into passive investments. And so we've been able to help Jared accomplish that goal. Justin Harris, Justin's now living in Portugal. He's living the life that I think a lot of us, or at least I aspire. All of his investments are on autopilot, and he's now retired and living in Portugal. So we've been able to help him out a lot through generating cash flow and income and through our income funds, and then growth through our national diversified funds as well. Same with John here, very similar story. And kind of already touched on this, so I'm not going to go into detail here, but we've got solutions for every investor. I think whether you are looking for growth or you're looking for cash flow and income today, or you're looking for both, happy to set up a call, either myself or Lon, and really happy to just brainstorm a strategy with you. I just had a really good 45-minute conversation with an investor today. He's got 5 paid off rentals, and he wants to start selling one each year for the next 5 years and redeploy with us. It's a very common investor, and it's a very common conversation. So we've had this many times. So if you have any questions, just feel free to email me. Nick at Ironton Capital's in the chat box, and we can take the discussion from there. And of course, we do a portfolio review as well. So if you want to dig into an analysis on a rental or 2 or 3, get in touch with me. Add my email address there, or you can go to irontoncapital.com review and schedule a time with us on our calendar. Well, looks like that's slide 40 of 40. So,
Yeah.
Well, we've got 7 minutes left. So if anybody has any other questions, again, really appreciate you joining us. There's a lot going on tonight, so it means a lot that you took the time out of your evening to spend an hour with us. So we have a couple minutes. If you want to send over some questions, we'll give it maybe 30 seconds. And if not, then we'll sign off and let you go enjoy the rest of your evening.
And I did input the link if you guys want to watch our recording on how to unlock your equity. As we touched on, if you might want to take cash out of a property, do a HELOC on a property and redeploy that capital into more passive investing, or maybe you want to sell a property. As Nick just touched on, he's got an investor who's selling 5 properties and redeploying that capital into passive investing. We teach a full 1-hour webinar on that, and you can click on the link there in the chat and see what that might do for you. Now, Glenn asked, Tim, look forward to seeing you on Saturday. Thank you. And Glenn said, do you have a stat on the in and outbound migration into the Denver area projection over the next 5 to 10 years? So the answer to that is no. I don't have that right in front of us. But Patty Silverstein, who is the chief economist for City and County of Denver, she does an excellent presentation. And I believe, I'd have to go back and check, but we are still predicting approximately 50,000 people per year moving into Colorado. Now, that is, of course, a projection, and that's been pretty steady over the last 5 to 10 years. But I expect that we are going to still continue to see inbound migration as well as natural population growth through, births and deaths. So I think it's still a positive place to own properties if, with my number one caveat, you have a property manager. But to answer your question, Glenn, no, we don't have that. But the last time I watched Patty's presentation, I believe the projection is still 50,000 inbound migration into Colorado over the next 5 per year for the next 5 years. And Nick, you correct me if you've seen that presentation more recently than I.
I have not, but I think it's a really good stat. Maybe we can include that in one of our upcoming, maybe on our next month's real estate trends. I think that's a really good. I think that's a really good thing to know. And, I think because of your answer, Joe, I think that really, despite the unaffordability that we're seeing, I know some of this stuff kind of seemed doom and gloom, especially with the landlord tenant laws. I think at the end of the day, I remain very bullish on Colorado for a number of reasons. And I think a lot of that is a testament to the quality of life that people experience here. And that's why you continue to see people moving here. So maybe it's not the most profitable rental market we've seen in the past, but you're still going to continue to see people come here and move here. And there's still going to be plenty of tenants and buyers and sellers. And I think it's going to be a really good market for many years to come.
I agree.
Yeah.
All right. Well, I didn't see any other final questions. So everybody, thank you for joining us. Nick, as always, thanks so much for letting me be a part of this. And as Tim touched on, we do have our Investor Success Summit coming up on Saturday. I'll put the notes here.
Nice. I'll be there as well. So if anybody here is to be there, it would be great to meet you in person.
Yeah. Yeah, you can go register for that. It's denveriss.com. It's at the PPA Event Center this coming Saturday, November 9th. It goes all day from 8:30 until 4:30. We've got, I believe, 12 speakers that are going to be talking about the Denver real estate market. I'll actually be presenting Denver real estate trends. So if you decide to come to that, you can skip my presentation because it'll be exactly this information, and you can see who the presenter is in the other room. But would love to have you guys join us. It is an entry fee of $39, but that gets you access to all of the vendors, get you access to all the presentations, and really just a great networking event for real estate investors. So hopefully we'll see you guys there. You can register at denveriss.com. And Nick, thank you again for having me. Always really appreciate the time.
Always. Thanks, Joe. Appreciate you being here. Thank you, everybody.
Thank you, guys.